Evening, everyone. We're going to give this 2 or 3 more minutes here to let people into the room, and then we will get started with tonight's presentation. So grab a glass of water, get situated. It's going to be 2 or 3 minutes from now, and then we'll dive in. Thank you. All right, everyone. Welcome this evening to our webinar tonight. Many of you may have been on last night's webinar. Thank you for joining us back tonight. I'm really happy and excited about the topic we're talking about tonight, finding the right capital partner, because right now in dentistry, it seems that it can be hard to navigate getting financing for that startup practice or getting financing for that acquisition. There's a lot of misinformation out there right now about how easy it is or how hard it is sometimes to line up this financing. And if we don't know the latest there is to know, we may not be making the correct decisions or may not be timing these big decisions in our career properly. So I'm very excited to bring in Provide. Provide is a bank that I've worked with for a very long time. They are one of the very top banks in dentistry and also one of the most dentist-friendly banks in getting excellent financing for startups and for acquisitions. What I typically see from their deals is really good terms and really high loan amounts and a lot of flexibility. And so I'm hoping that this session tonight is going to give you some practical insights into what it's like to get financing, what to expect, and kind of the latest and greatest in today's environment on getting the money to buy a practice or start a practice. So if you have any questions for tonight, please type them as soon as you have them. Type them into the chat, and we will be answering those questions while we're giving the presentation. Also, make sure you stay to the end for contact information to connect directly with Provide, as well as an offer to connect with me or to go to one of my events. And also, if you look at the chat right now, there is my Instagram handle. If you ever want to send me a message, let's say on another day, another evening, you've got a question about something and just want to reach out to me directly, connect with me on Instagram. That's my personal Instagram account. And you can always send me a message there. All right. So I am going to do very little talking this evening because we've got a lot to go through and super important information. So I'm going to hand this over to Paul and Gina from Provide. And thank you guys so much for logging in this evening and just being open and direct and giving Dennis real world insights into the world of financing practices. So I'm turning it over to you. It's all yours.
Thank you, Scott. Really appreciate it.
Thank you for having us on, Scott. We want this to be as educational as possible, just for when you are ready to approach a bank, how you can have as much success as possible with your vision, what you want to accomplish with a lender, make sure your values are aligned, how to get yourself ready. So, when you do approach a bank, whether it's Provide or anybody else, that you're very, very prepared for what's to come and in your financial life. My name is Paul Motter. I am a national sales manager with Provide. I've been in dental for over 20 years, a lot of it with private practice and some of the private equity side and DSOs. So if you have questions on how to build your small dental empire and what you want to try to accomplish as you go, we want to try to answer as many career-oriented questions and banking questions as we possibly can. And hopefully, my rounded expertise can help out with that. So just if you want to expand, if you're starting your practice and you have goals of getting to 10 practices plus, we want to do whatever we can to help you get to that, help you realize your vision. So, Gina, you want to introduce yourself?
Sure. Yeah. My name is Gina Buchmeyer. I am a regional director, and I focus on the Southern Central region. My expertise really is in the startup project and commercial real estate component of the dental financing world.
All right. So just really quick, we have a lot to cover. So just a quick history of Provide and how we were founded. Our mission is to, you can see it, financially empower healthcare providers with great people and innovative technology. Great people, it's still very much a relationship-oriented business, the people that you have around you to help you succeed. And so we want great people within our organization and feel like we've done a good job at bringing in people that really care about every step of the lending process. Then innovative technology is what kind of differentiates us and how we came about. So a little history of Provide. We were founded in 2013, and then as a financial tech firm, saw a lot of opportunity in different aspects of finance. So it was becoming very prevalent in mortgages and other sectors of the banking industry and financial industry. And we decided we were going to go after small business loans. But as we kept hiring more people, had a little bit of expertise in the healthcare side, we saw a huge opportunity. A lot of us have worked for other organizations within banking and how antiquated some of the processes could be and how we could roll fintech into healthcare to make it a little bit of a better process for people to understand how they could get loans and really have just a better user experience on the front end. So we signed our first bank deal with First Internet Bank. Fifth Third joined, with the tranche of money to help us write a portfolio. And with the success that we had in banking in general, in the healthcare space is one of the lowest risks that you can take. So Fifth Third and everybody else that had some funds with us, were very interested in partnering, and Fifth Third decided to purchase us in 2020. And we're a wholly owned subsidiary of Fifth Third Bank now. So we have the capital backing of Fifth Third, but we still have a lot of the processes and things in place that we fit, that were founded, that made us a little bit different in the market. And we are, we continue to innovate and develop that technology to make it even easier for you to grow your business and make sure that that you can accomplish what you need to in the finance world. A little bit of how we're different, and I'll let Gina get into more of the process, but it's just the user experience in general. With a fintech, everything is digital interface. You can upload everything, collaborate a little bit easier. It's a mobile optimized application, so you can get on your phone, pre-qualify in 2 minutes, know what's available to you when you're starting the process. And then again, just have everything at your fingertips to make each step of the process a little bit easier and fine tune, then having to print out documents and scan them back and, go back and forth with emails on what's needed. We developed a practice marketplace. So, if you're interested in different opportunities that are in different markets, we take a lot of pride in what we've set up to be able to search different opportunities in every market in the U.S. So if you're looking in not only where you live, but you want to relocate to a different market, all the brokers have their opportunities on our marketplace for the most part. And we want to make sure that's as easy of a process for you to find the right opportunity for you, whether it's acquiring or starting a business. So, but the crux of this is the user experience and the relationships that we have with our clients. So a short video here, and then I'll let Gina get into more of the product set and what's available to you in the market and what to look for as you approach a bank.
Tom and I were good buddies in school, and I was like, hey dude, like, do you want to come out west? I'm gonna open a practice. Bend is my hometown, but everybody was like, oh, you're never gonna make it. Like, Bend's saturated with dentists. This is a highly competitive environment.
Because of knowing him for so long and seeing his success in life, I just knew that with Alex it would succeed. We built our practice based on what's best for the patient. We focus what we're doing based on what the patient needs, not what their dental insurance is dictating.
It's great to be able to do the best work, provide the best service, provide the best patient experience, and do so at the fraction of what these patients have been given treatment plans and estimates for in terms of their care. Provide has gone so far beyond the normal limitations of what we could get for lending, and it has to do with that relationship. It was fun. It was like rekindling an old friendship, catching up, and then like being shocked at what we were asking for, and then like being creative and like, how are we gonna get it done?
They believe in us, they believe in our model and what we're doing.
Working with your hands and creating somebody's brand new like smile is one of the best things. That's like the stuff where like tears come out and patients are like crying because they're so happy, and you really did change somebody's life. It's not just like fixing a tooth.
Being able to do that for somebody is really what makes us do what we do here.
So really what we want to get into is how to align yourself with a capital partner, a lender, to ensure that they are supporting you and your business's goals, short-term and long-term. So the main components we really feel is the lender willing to support you and your project entirely? Do they have the lending products that match your growth desires? Are they willing to support your growth, or is their model less designed for growth? Do they have flexibility to be able to move with you, work with you within your project, within your growth structure? Do they provide you the relationship and the customer service that you're looking for? And do they have the products built in to get your business operating to its full potential? So as far as lending products go, we have a full suite. We really are dental focused. We have everything that a dentist really can need for any type of component of their business. So we can do acquisitions, we can do startup, we can do ground up, we can pull equity out of practices so that they can invest in another component of their business. We have SBA lending, banking, different types of loan products that are unique to us. And really, if you're looking at a practice and eventually you want to purchase the real estate, if your lender isn't able to offer you that, you could be stuck in a sticky situation. So that is very important when you are digging into your lender to know that they have the products that can support you. We do also have the Provide card. This is unique to us, where our dentists get 3% cash back on all dental and lab supplies, 1% cash back on everything else. We started this about 2 years ago. It is a really unique component, and it really does help our dentists with their practices and their operations. So what does the loan process look like? And lenders, there's components where in the healthcare lending space, we all do things the same. And then there's ways we get there that is unique to each lender. And that I think is important to understand. So in my opinion, you should call a bank as soon as possible. There's no harm in calling them if you had just graduated school and you want to own your own practice 5 years down the road. They can help you build that plan so that you can get there 5 years from now. Or if you're looking at acquiring a practice in 30 days, you need to talk to that bank right now. So in my opinion, the banks, they will take these phone calls at any point in your career. Get on the phone with them as soon as possible so that you know where you are and you have a roadmap to where you want to go. So there's two timelines that I kind of want to focus on. There's the acquisition and then there's the startup. They are a little different. So in the acquisition component, understand what you want to be for an owner, what type of practice suits you. Pre-qualify so that the sellers and the brokers know that you are financeable. And then at that point, submit your LOIs and then secure your financing. Then from there, you'll go through the closing process and you will then eventually be an owner. I made that sound a lot more simple than it actually is, but that is generally speaking the timeline that you want to follow for an acquisition. When you are looking at a startup, you're playing a little bit more of chicken and egg. So you're creating the vision, but then you want to secure your financing, in my opinion, because you want to know how much you can borrow so that you can then tailor the vision for that practice to that component of financing. So if you're looking at a practice where you're going to need 500,000 in tenant improvements and your rent's 15,000, and then you turn around and you can't get that financed, you could be in a sticky situation. So I often tell folks to get your financing secured, then look into your space, know areas where the bank can move around with you, and then get into the practice, start designing, get the equipment going, build your team, procure the permits, and then essentially, eventually open the practice. We have another little video here for doctors, just kind of getting to know Provide. So I'll play that for you real quick here.
Years in school, learning about your specialty and the type of care you'll provide after you graduate. But when it comes to actually planning for the future, where do you even start? Provide's startup loan is tailored for promising first-time practice owners. So we can help you through every step of the process. That way, when you're finally ready to open your own practice, a place where you can be your own boss and deliver the quality of care you believe in, you can focus on creating something special and uniquely you with Provide.
As far as the practice loans go, when you are pre-qualifying, there's certain considerations you want to look at. So how much do you qualify for? How much do you need? How does the process work? And how long does it take? As far as pre-qualification, Paul did touch on this. For us, it's 2 minutes. You can do it from your cell phone. It's a soft pull on your credit. It gives you high-level information so that you know what your lending capacity would be. And so it also speeds up the process, and with us, we do everything online. Other banks do things differently, but for us, it's just super easy, 2 minutes from your cell phone. For the pre-qualification, the main components we're going to look at is your credit. So is your credit in good standing? What are your debts? What are your credit card debts, housing, student loans, auto? And how is that going to factor in, and what type of practice you're going to need? You're going to need to match your practice. So if you have 6 houses and 10 sports cars, you're going to need to acquire a practice that brings in a lot more revenue than than somebody that has lower payments. So I'll get into the cash flow in a little bit here, but the main components we really look at on the pre-qualification is your debts, your credit, and then we also look at your experience. Do you have a specialty? How much are you producing? So we're going to look at your personal financial situation, and a large component that lenders are going to look at is your net liquidity. So your net liquidity is your cash, savings, stocks, bonds, less any credit card debt. So if you've got 100,000 in the bank, but you have 10,000 out in credit cards, your net liquidity is 90,000. So as we discussed, we can do it all online or from your cell phone. And then from there, you're going to complete your application and you're going to go into the underwriting process. So all of these banks in the healthcare space, we underwrite and we base it on the cash flow of the practice. So if there is an existing practice for an acquisition, we'll base it on the cash flow of the existing practice along with you as the borrower. And for a startup, we will project the cash flow for the practice. So the considerations for an acquisition, we will look at 3 years of tax returns for a borrower. We're going to look at their production, their net liquidity, and essentially their history. And then from the practice that they're looking to purchase, we're going to look at the financials for the practice. We're going to need some information on the practice, such as rent, the insurance breakdown, et cetera. And we are going to do a cash flow to ensure that the borrower and the practice match each other. For a startup, it's a little different. We really hang our hat on our borrower. And this is one of the areas where we are different than most lenders. Essentially, a stronger doctor, I can get a much stronger loan for. A stronger doctor is going to have a stronger practice than a doctor that isn't producing as much. It just makes sense to us. So we're going to look at their production, their net liquidity, and then their earnings while they're associating outside of the practice. So the deal needs to make sense. It needs to make financial sense. The practice and the doctor need to match. They need to be a good fit. As far as the acquisition components, when we do the cash flow, we're going to look at the financials for the practice, and we are going to add into the cash flow the net income, the interest, depreciation, amortization, entertainment components. We're going to add that back in. But we do a global cash flow. So we look at the doctor, the expenses for the practice, we add back those components, and we create our cash flow.
Yeah, Gina, if I could interrupt for just a second, because this is something we teach very heavily in our multi-location seminar on how to acquire practices and how to do this analysis. For those of y'all that have been to my event, this is what she's talking about is what we call pro forma analysis. So you take the seller's profit and loss statement, and that profit and loss statement is not very accurate, and it does not represent what's going to happen when you own the practice. That seller's put their meals in there. Their kid that doesn't work there is somehow getting paid out of there. Their car is getting paid out of there. You're not going to be paying all of that when you own the practice. So what the bank is in essence is doing is also what you should be doing. You are adding back those expenses because they're not real. Mm-hmm. And what you're trying to get at is, okay, if you own this practice, how much money would you make? For real, how much money would you make? Because you wouldn't be paying for the seller's car. So that would be money you'd be making. The bank is going to then look at that as well and make sure that the financing terms of the loan and, of course, the sale price of the practice all can support, or can be supported by how much money the practice is actually going to be making in this analysis. Did I say that correctly, Gina?
Absolutely. Yeah. Absolutely. And the bank is going to look at it a little bit more conservatively than maybe your CPA would in components, but that's also feedback that the bank can give you. This is my favorite part of the job, is running through the numbers. I do these cash flows in my sleep. I literally wake up thinking, oh my gosh, I could add this back and now we work. So this is feedback the bank can give you, but we are going to be a little bit more conservative as a bank because that's just the nature of it, right? As far as underwriting for a startup, we have some unknowns, right? We don't have expenses for a historical practice. So we will usually enter an estimation on the rent. If we know the rent today, we will enter that in. we're going to take the doctor's production history, and then we're also going to take their associate income, and we're going to factor that into our cash flow. So if a doctor is going to associate 1 day a week outside of the practice, we're going to factor in that income for 1 day. But if they're 2 days a week, then we would add that back into the cash flow. And so this really is hung up much more on the doctor and their history versus the historical numbers for the practice.
So Gina, I'm sorry to interrupt again, but let's say a doctor's like, look, I just need financing. I will do what I have to do to get financing. I will do what I have to do to be a good person to underwrite and qualify for. So so that dentist that says, I want to do a startup practice, it's in their best interest if they have an associateship that they keep after they open their startup. So that's correct?
Correct. Yep. So we're going to want them associating outside of the practice. But at the same time, we don't have a requirement that they stay associating for X amount of time. Some lenders might. But we will want to use that income and then have them use their best judgment to taper out of the practice of which they're associating.
So the higher the income they have from an associateship, that goes into the underwriting formula. So that dentist that has a higher income from an associateship is going to be easier to qualify then for a startup loan. What about a dentist that has been in an AGD or a GPR for a year? Are you able to pull a production history for that kind of dentist?
So production reports are the easiest way to back into production, right? I mean, that one's the easiest. There are components where if they're paid a percentage on their production or collections, we can back into the number that way. But if they cannot get us any numbers, the way we use it is we'll use assumptions. So if you've been a general dentist for a year or more, we assume that you can produce at least $550,000 a year. So we can use that. At the same time, I can get into these bigger loans by using higher production. So if you're able to capture your production, and I don't need last year's, I could use production from 4 years ago if it's stronger. I only need 4 months and I can annualize those. But that's how we kind of fatten it up and build that doctor up.
So we find the 4 really good months we've had that are indicative of what we're able to do.
Exactly.
And if I'm working in a practice that has big write-offs, can we give you the fee for service numbers, the production numbers, or do you need the adjusted down numbers? So this practice happens to take a lot of insurances where the fees are really low. I can produce a ton with my 2 hands, but I happen to be in a practice with really low fees. Which number do I give you? The cash fee number or the low fee, the insurance fee number?
So there have been times with doctors I've been able to really dial into that because I did have a situation where the doctor was a heavy producer, but the practice wasn't taking in a lot of income. So what I did with those numbers is I matched them to the practice he was acquiring. This was an acquisition. And I was able to then essentially demonstrate what he would be able to produce in this practice. So there are times where we can really dig into it. Sometimes you got to, right? I mean, ideally, it's a beautiful production report, clean and easy, but that's not the story for everybody. Really, as my job is to help paint the prettiest picture so that when we're in underwriting, and here we go, we're off to starting our own practice.
Okay, so to just sum it up, and then I'll stop talking so much. To sum up, if I'm a young dentist early in my career and I want to get financing, a strong way to go about this would be to find 4 of my best production months, whatever practice that was in, that really shows I can produce if I'm given the right environment. And even maybe report to you the UCR fees if possible, so that I'm not discriminated against because of low fees that this practice happen to have. And if I can have a part-time associateship on the side when I open my practice, that will reduce my risk in the eyes of the bank and therefore make it even easier to fund me with what I need. Did I say all of that correctly?
You did.
Okay, excellent.
Thank you.
And our underwriters too, and with any dental specific bank like this, they're healthcare oriented underwriters that understand that those fee schedules and how that's gonna differentiate as you're looking at different opportunities. So we've got a lot of support on the back end from underwriting there too.
And you know, one of the questions was, well, what is a healthy production number? What I heard Gina say is if we don't have production numbers available, we're going to assume this kind of minimum that a doctor can do 550,000 in a year. But I would imagine a healthy production number would be anything above that. So anything that's annualized more than 550. So more than 45,000 a month. If we can show that, that makes us stronger. Is that correct?
Correct. Yep.
Okay.
Exactly. So the banks, the way we get to this cash flow number is different, but the kind of the magic number we look at is for every dollar of expense that the doctor personally has and every expense in the practice, we want there to be $1.25 coming in. That's where we're comfortable. Now, if there's $1.50 coming in, great. If there's $2 coming in, go run and get that practice. So that's kind of how we get there. But the way we get there, the way we underwrite it, that is one area where we do vary. So for us, we factor in the outside income. That is one area where we are different. There's other components as well. But kind of the magic number, if you're talking to your bank and if they're saying, well, we're not meeting our cash flow, it's because you're not at that 1,125 number.
So if I were to put this in layman's terms, the collections of the practice plus any sort of outside income I might be getting as an associate, that all adds up to a certain number. Let's just call it $1 million.
Yep.
And then we subtract from that all of the practice's expenses and all of my personal expenses. Is that correct? And that gives us that top number. And let's say all of those expenses add up to 600,000. So we're left with 400,000 as the top number. And then we divide that by our debt payments, the practice debt payments and the personal debt payments. And we need to make sure that when we do that, we get 1.25 or more. In other words, if I'm 400 grand on the top number, then I need to be 320 or less on the bottom number. Did I say that correctly?
You did. Thank you.
All right.
Yep. Once you are through the underwriting process and you've accepted your loan, you will go through the closing process. The closing process is a little different for an acquisition versus a startup. For an acquisition, the banks will require that you have your insurances, your lease, your purchase and sale agreement, and then any other requirements that they have. For the closing process and the project process for a startup, that is a little different. So that is based on certain draws. So when you are doing a startup loan, you might be approved for 800,000, but month one, you might draw 50,000. So your loan is only 50,000 at that point. Month two, you might draw 100. So now your loan is 150. There's certain requirements that we have based on the level of the amount of money of which you've drawn. So for first draw, we only require a draft of a lease, entity formation. We need to verify your liquidity, what you stated on your application, verify your residency. Second draw, we need the executed lease agreement. Then we kind of get in with the project team. We really kind of fine tune the budget. And this area is, some banks are able to be more nimble during your project and moving the budget around. Some banks, it's an act of God. So that is an area where I would really dig in with your lender if that is the route that you're going to pursue.
And I'm curious, before we get into the case studies, what is a typical range, a loan amount for a startup in today's day and age, on the low end to kind of the high end, but within normal, typical, what does that look like for a loan?
Yep. I would say on the low end, you're probably looking at 750. Realistically, construction costs are the highest they've ever been. You're probably looking at about 800 these days.
Yeah.
800 plus.
Yeah. And one thing I've noticed about Provide is when I've compared Provide to other proposals, you guys are really strong on getting a dentist like fully capitalized. So, really, really pushing that number up really high if the dentist needs it. I've noticed that's a very clear when we look at your proposals compared to some of the other banks. On the acquisition side, when we talk about limits, at what point does a practice purchase amount start getting so high that it gets really hard to underwrite? So I would imagine a practice that's doing that's on for sale for 400 grand, as long as it meets the ratios, is easier to underwrite. But how high can we go before it starts getting really hard to get a loan for that?
Sure. So most lenders, they don't want to exceed 100% of the gross revenues for the practice. So collections of the practice.
Mm-hmm.
But that also needs to factor in the doctor's working capital, and they need that. There are times where we can exceed 100% of the gross revenues, but the cash flow really needs to support it. Now, that doesn't mean that practice isn't worth more than 100% of the gross revenues. But a bank can't necessarily tell you that it's not worth more. It's just they can't finance it.
Yeah. So, and I'm going to ask a different kind of question, but what you just said is some practices are for sale for a really high price compared to what they collect. And typically banks shy away from, a practice being bought for 100% of collections. However, if it's super profitable, it can afford to pay those loan payments compared to a practice that's not super profitable that's for sale for that same price. So if this practice we're looking to buy is more profitable, it can support obviously a higher purchase price that would get approved by the lender. My next question is though, how big of a loan becomes too big of a loan in the bank's eyes? Even if the practice sale price is reasonable, is there a point where like, I got a $5 million sale price on a practice that's profitable? Is that too high for a lender to say, okay, we'll take on that risk with this single private dentist? You know what I mean?
Yeah.
How high does it start getting difficult?
Yeah. And every bank does this a little differently, and it has changed significantly. Paul, what's the largest acquisition loan? Just acquisition, not factoring in real estate, because we've done those. Do you know what the largest acquisition loan is that we've done?
In the 4.5 to 5 range, but that was a practice that was on autopilot with associates that were staying there. Producer that was doing 1.7, 1.8 himself, so covering more than 50% of the doctor production. You've seen those numbers, like the sale price numbers, percentage-wise, go up over the years, just because the DSO space has helped to drive that up. I mean, the numbers that they're offering to have solo docs go in and try to compete with some of those offers, the banks have needed to be a little bit more creative there. We've done deals up to 100, 125% of revenue just because the profitability supports it, but it's difficult to get those loans done. I mean, it's got to be a very good practice.
If you're talking about a single doctor practice that we're acquiring, because some single doctor practices have really high collections, they're really big producers. Is there a certain level where now the bank's saying, okay, this is a different risk profile because now I'm worried that the buyer can't repeat that number? Is there a certain amount? Is it like a $2 million practice or a $3 million practice? Is there a certain amount, or is there not a certain amount like that?
Right in between there, 2.5 million and up. Once you get to 3, you get a little bit. You just have to develop those deals a little bit more and make sure that the doctor that's coming in understands what they're getting. We do a little bit more due diligence on our end to ensure that the success is going to be there post-transition. Okay,
so if I were to kind of sum this up in my words, if we're buying a practice, as long as it's doing 2.5 million or less, we kind of fall in the category of relatively straightforward to go through underwriting. And if the practice has healthy profit, then it's easier to underwrite the purchase price, even in situations where it's kind of a high price, like 90% of collections or 100% of collections. As long as the profit can support the loan payment well, that could still get underwritten. In addition to that, the dentist trying to get the loan, because of that formula that needs to end up in 1.25, if we can minimize our personal expenses, minimize our personal debt payments, and of course, maximize our income streams, then that just makes it so much easier for us to get underwritten. So for an example, it might be easier for a dentist to have a modest, affordable place of living instead of having invested in owning a home with a big mortgage now with big debt payments. We might want to prioritize buying the practice first before diving into heavy personal expenses. Did I say that correctly?
You did. But one of the expenses that is unfortunately a necessary evil in this industry is student loans. And most dentists that we are working with have them. And obviously it does impact the cash flow. But it is something that we are used to. So student loans, generally speaking, we would advise, obviously you got to pay them, but pay as little as much as possible, or as little as possible, so that you have your war chest of your liquidity stockpiled. So then you kind of demonstrate that you're a strong borrower. Another thing too is when we look at that practice, we would like for the buying doctor, their production to kind of match that practice. So if they're buying a practice that produces $1 million, but they're producing 550,000, now we're going to have to factor in an associate in that practice to bridge that gap. So that could also impact the cash flow as well.
So you said something really important.
Mm-hmm.
A lot of dentists think I need to pay down my school debt.
Yeah.
Right. And what's important is that in the first part of your career, when you're trying to get funding, when you're buying or starting something where there's real kind of risks to your financial stability, the power is having liquidity, not paying down your debt faster. So what the safest, most conservative thing a dentist can do is make the smallest payments possible on the debt so that they could build a cash reserve to protect them. There comes a point in their career where it tips. Now, there is not a lot of risk. They do own the practice. It is cash flowing well. And then the question becomes, should I start paying down debt more? And that becomes a financial exercise with your accountants, looking at tax implications and interest rates you're paying on your different debts, including school debt, to decide, what kind of schedule am I going to have to pay down my debts? So if you're listening to this and you don't have a practice yet, and you're starting to kind of earn more money than you need to live on, the most powerful thing you could do for this conversation is to save that money in some sort of liquid state like stocks and not use that money to pay down your debts faster. That will protect you. It's the most conservative thing to be well capitalized, and that will enable you to get underwritten better with the bank and get the loan you need.
Yeah. Liquidity became much more of a priority post-COVID, because before that point, we saw the risk on these deals, but we didn't see any financial strain with a lot of doctors. And then in that process, when we're relying on government funds for a few months, credit took a little bit of a different stance, underwriting shops and all banks, and just prioritized liquidity, because the people that were better liquid in that moment were less reliant on government funds to get through that.
Yeah. And, having liquidity is what's smart to do, not just because maybe banks want it from time to time, but it is the right way to protect yourself in the world of entrepreneurship. But let's not think to ourselves, I haven't saved much, and so maybe now's not the right time for me to own a company. Okay. Let's not think that. We need to go through the process of seeing what would be approved for and seeing what that could do for us, because the fastest way we could be wealthy is to own the practice earlier in our career. So let's not make any assumptions about whatever screwed up financial situation we've had to deal with in our own personal lives. Let's just understand the strengths and weaknesses of that, but still go through the process of getting approved to see what is possible.
Yep, exactly. And that actually leads perfectly into the first case study that we have. Dr. S, he's been a dentist for 9 years, but he's only been in the US for 2 years. So he had to go back to school, incur additional debt, wasn't able to save as much. So his liquidity when he came to us was 3.5% net liquidity, 3.5% of the total loan. But he and I put a plan together to save prior to opening. He's a producer. He has very strong associate income. He also does have coaching. That's another strength that we can play in. So we've got all these strengths. We've got a couple of weaknesses, right? He's got student loans. He hasn't been able to save as much because he's only been licensed for 2 years. We were able to get him a loan of $800,000, and he's just about ready to open. So it really is a scenario that put the plan together, know where you're at, see what you could borrow today, and then know what you could borrow tomorrow if you're able to save. Another doctor this is a Jumpstart Plus. So we talked about acquisitions. We talked about startup. Another loan product that we have that is a little unique is for a practice that at one point was performing, but then for some reason, and we need there to be a reason, but did decline. Often that reason is the seller basically retired, should have sold 5 years ago, but banks want to see a practice that is maintaining or increasing revenues. Well, this is a practice that has declined in revenues. So what we do in that scenario is we look at the doctor who's buying and we look at their strengths, and we then underwrite kind of a combined hybrid of an acquisition startup. So this is a practice that went down. The doctor that's buying this practice, really strong liquidity. She's a strong producer. She has strong associate income. Her weakness is, or the weakness is, the practice is underperforming. It's incredibly dated. I mean, it's paper charts. It needs some improvements, and she has a lot of student loans. So we were able to finance the practice. We're able to finance the real estate. We're also able to finance $100,000 in equipment and $120,000 in tenant improvements so that she can get that practice to up-to-date standards.
Hold on. That's really important what you said as well. So often when we're looking at practices that are for sale, man, they just turn us off because they've been shrinking. They've been not as profitable as they used to. They're dumpy. There's no technology. It looked like, you just stepped into a whole nother world of decades ago. So what you said is you funded to buy the practice and happened to also buy the real estate, but you also funded a lot of money to renovate the practice and a lot of money to bring it up to date with technology.
Correct.
And so it's important that when we look at practices that are for sale, let's not get turned off by the dumpiness of these old practices. Know that becomes part of the loan strategy. And it's actually beautiful. It's like buying a house where the kitchen hasn't been redone yet. Now we get to pick the cabinets and the colors and the counters. So when we buy these dumpy practices, if we're with a bank like Provide, we can potentially have the budget to now upgrade it to what we want it to be.
Exactly. And not only that, but also give them the financing for marketing and coaching if they need it. So that is another component where there's a lot less risk built in a loan like that, if that makes sense. Here's the renovations that she did in the space. So significant difference. And then there's another loan that we're doing. It's a ground up, and I actually believe he's attending the webinar right now. So hello, Dr. S. But he's in an area where he's a first-time owner. There's no lease spaces. There's no buildings for sale. He's got to build it. It's 4,000 square foot building that he's planning to build. He is a strong doctor. He has really strong liquidity. He's a monster producer. His associate income, $600 to $800 a year. He also, where he's working now, it's a Medicaid practice. That's what he plans to do at the new one. He also has coaching, but the weaknesses are he's never owned before. So it's a lot riskier to do ground up construction for a doctor that never has owned before. There's also less opportunity to pull equity out of an existing practice to then put into a ground up construction. The land, this is also another tricky bit because the seller wants to close in 45 to 60 days. With this loan, we do have to go SBA. SBA is an amazing, amazing loan product, but closing SBA in 45 days, that's not going to happen. So what we've been able to hopefully structure with this one is the seller carries a partial note. The doctor injects a certain amount of cash. Once we open our loan, we take out that seller note, reimburse the doctor, and then we have the SBA loan open. And so we've got just under $3 million approved for him, 100% financing on everything. And it's a great opportunity for this doctor.
Gina, I'm going to have to say what you just said in layman's terms. So because some people may not even know what SBA is. So an SBA loan is the kind of loan where the government says, hey, we'll take on some of the risk, bank. We believe in the entrepreneurial spirit of our economy, and we've agreed as a government to take on some of the risk when you give loans to entrepreneurs that you would otherwise not give loans to. Mm-hmm. And so in this situation, to get a freaking $3 million loan for a startup, that is a situation where it pushes it into, hey, government, we need your help de-risking this for the bank. And the great thing about that is, like, it's such a great program. However, the drawback is it takes a long time to go jump through the hoops and fill out the paperwork to get it approved. Mm-hmm. So what you said was the land needed to be sold quickly. So you thought very creative, like tons of creativity here, which is awesome. You said, okay, seller, if you just kind of carry a temporary loan, then we'll take out your loan. That buys us the time to get approval for this. Not only will you be able to sell it at the price you want and have really all that risk taken away pretty soon, but we're also able to give Dr. S 100% of what he needs to build what is going to be probably the most significant thing he does in his career, a $3 million ground up construction project. And Dr. S, I know who you are. We spoke a couple times. So I know this deal well, and I'm super excited to see what you do, because this is one of the best opportunities I have heard of in a long time. Awesome, Gina. Sorry to give the layman's explanation there.
I appreciate it. It's one of those things I forget. I do it all day, and then I forget that folks that this is their first time. And one of the really neat components about our SBA loan product is that it's designed so that we then flip that doctor to a conventional loan product. And it's designed to do that quickly. So if there's a bank out there that only offers SBA, they're phenomenal at what they do. But where's their incentive to get you to a conventional loan where there's a little bit more aggressive terms and rates? There is no incentive. Whereas for us, it's built in for us.
Yeah. So those of y'all that don't know, banks end up selling the paper or the loans to each other or to other institutions. And what can happen is, if you get an SBA loan, it's so awesome. You got it because you were asking for more than what a normal bank would say yes to without it. But what Gina just said is, once you're on that SBA loan, everything got approved, everything got funded, they can flip that loan into a new loan, kind of like refinancing the loan into a more traditional loan with terms that might be more advantageous for you. Maybe the payment structure is different. And so it reduces your cost. So it's not just one SBA loan and done. Gina says, no, not only will we help you get the SBA loan, but once it's done, then we're going to try to get you into a better loan.
It's a bridge. Exactly. So there was a video that I wasn't able to upload, but it's a time lapse of a ground up construction. And this is not Dr. S's practice, but it actually is another practice that we did in Ohio. The last thing I really want to hit on for folks is really assembling their team, assembling the experts that have done this over and over and over again. Because you may do this once, you may do this 5 times, but single project has its own nuances. Build experts around you that have done this hundreds of times so that they can lend to you their expertise so that you have the most success possible. So there's a lot of there's advisors that you should have on a acquisition startup. A lot of them do overlap. Coaching, we really do believe in coaching. We believe in the experts that have done this time and time again to be in your corner. We often will finance the coaching in the loan, dental specific CPA, dental specific attorney, marketing brokers, contractors, really sticking with the folks that do this over and over again. So that's one of the things that I just cannot hit home hard enough.
Yeah. So like if we kind of use an analogy, if I wanted to, I'm a great cook and I say, you know what, I want to own my own restaurant. What you're saying is you got to have this great team in front of you, but not only would I get a loan to start my restaurant or to buy a restaurant, but you as a bank would say, hey, we'd also like to fund an expert coach to hold your hand in this whole process because you are not the expert yet. You haven't done it 100 times. So not only will we give you all the money you need to actually do the deal, but we value coaching so strongly that we'll give you the extra money to fund the coaching as well. Did I say that right?
Yes, you did. Yep.
Yeah. And so I think a lot of people would be a fool to open a restaurant if they've never opened one before and not have a consultant or a coach help them through it. And I think when it comes to dental, there are so many incredibly important decisions that have a huge impact on you financially and mentally and success with your success, that it's very smart to have some sort of expert alongside you, guiding you through the process. And then of course, helping you see what you normally wouldn't see, helping kind of condense the time it takes you to be super successful. So, it really is now, we're in a day and age where coaching or consultants is one of the key ingredients to doing this. And of course, I am a coach. And so, I have a conflict of interest in saying it, but it doesn't make me wrong. It doesn't make me wrong. And we see it all the time. Our doctors that we coach do insanely well. So just make sure that on your budget for acquiring a practice or starting a practice, that you have communicated to the bank that you would like a budget to also hire some sort of consultant or coach to help you along the way.
Well, the next steps, you can scan this QR code. That'll bring you straight to the pre-qualification. So I'll leave that up there for a second. And it's only a soft pull on your credit, so it does not impact your FICO. From there, we can schedule a call and we can walk you through your timeline, how we can help get you there. These are calls that I'm there. It's my favorite part of the job. I'm happy to do them on the weekends and evenings. I do like to schedule the appointments for evenings and weekends if possible, because I do have a little bit of a life, but not much. And my contact, you can scan this QR code here for my contact, and that'll bring you right to my business card. And I'd be happy to walk you through all of this. Then we do have here for the Leune group,
Gina, can you hear me?
I can now, yeah.
I cannot hear you at all. I apologize, guys, but I've had some sort of technical difficulty. I cannot hear anything you're saying anymore. So if you can hear me, I just want to say this slide that you're looking at right now, if anyone has thought about coming to one of my events, if you want me to train you how to buy practices or how to start practices, look up the information. They're very intense events. It's 2 days of just a ton of content on exactly how to do this. And if you use this code from Provide, you will save 25%, which will help pay for your flights and your hotel. And I know that most of you have probably been to my events, but if you haven't, you should definitely look into it if you are ready to learn how to do this the right way. I do apologize because my audio just went out, so I can't hear anything. But Gina, are you able to look at the questions that were asked? I know that most of them were answered, but if you could kind of take this over, and in just a second, this last slide, I want to remind y'all, we do have a really cool podcast, the Dental CEO podcast, where we interview people inside and outside of dentistry. Go check it out. Subscribe to it. I interview really big names, just like my first episode was with Damon John from the Shark Tank. Subscribe to that if you haven't already. It would be a great habit to put into your week when you're driving to work or working out, is to start listening to this type of content about how to build wealth and how to be entrepreneurial and how to be a CEO. All right, I'm going to have to stop talking on my end. So Gina, I'm going to pass it on to you while I try to figure out my audio problems. I just want to thank you, Gina, for doing this. So go ahead. If you can finish up what you needed to say and wrap this up, that would be awesome.
Will do. Absolutely. So I want to kind of dive into the Q&A. One of the questions was asking if we could go back to the slide on Provide. I can tab back there, but essentially the Provide card is a credit card that we offer our doctors that is exclusive to doctors that do borrow through us. So it's not something we can give to a doctor that has done their loan outside of Provide lending. The card, we do give our doctors 3% cash back on all dental and lab supplies. So that is a huge amount of savings for many, many practices. The first year, it's 0% interest. Outside of dental and lab supplies, it's 1% cash back on all other items. You can use that for hotels, travel, but you could also use that to pay your loan. So there's a lot of added benefits with that. And it's a really neat product that we have built in for us. And okay, sorry, I moved the questions around. There are a lot of credit cards to choose from. And in my opinion, the major advantage to the Provide card is the dental and lab supplies. So if a doctor just used it just for that, it would benefit their practice and their bottom line there. What is a healthy production number? Scott did address this, essentially anything 550 plus. And then how does Provide work with multiple acquisitions or startup? So I would imagine that question is if the doctor is, well, there's two scenarios. I suppose I don't know which one we're asking about. So if you're asking about if one doctor is looking to acquire two practices or more at the same time, or if a doctor is looking to acquire one practice today and then a year down the road, another practice, so on. As far as a doctor being able to acquire two practices, if you own and you're looking to expand and acquire more down the road. So one of the components, banks, generally speaking, need to cross-collateralize the practices. So if you have practice one with bank A, it would be very difficult to do practice two with bank B. And the reason being, practice one, that's your cash cow. That's the practice that does really well. Practice two, that's a new business for you. And if that one is suffering, you're not going to let practice one suffer. And so in that scenario, then bank B is an alert, right? So generally speaking, banks need to cross-collateralize these practices. But let's say you have your loan with Provide and you are looking to do a second location, a third location, et cetera, down the road. We certainly, the main factor for us is the cash flow. So that is the biggest component for us. So if the numbers make sense, we can do it. But if your existing practice is suffering, we cannot do it at that time. So we may have to say, hey, we got to come up with a plan for 3-6 months down the road to get this practice built back up so the cash flow works. Another component we want to look at is the production. So if you're the sole producer in practice one, how are you going to ensure that the production at practice two is met? And you may need to hire an associate to bridge that gap. And that's fine as long as the cash flow supports it. So those are the two main components. But some lenders are designed to support your growth, and some lenders are designed, I don't know if they're designed to hinder your growth, but they can hinder your growth. So that is very important to discuss with your lender when you are looking to do your first loan, because your first loan, because they have to be cross-collateralized, we kind of say whoever you do your first loan with is essentially kind of who you marry. And I don't see any other questions, but I'd love to hang around in case anybody else has some. Well, I'm not seeing anything, but oh, thank you. But obviously, you know where to reach us, you know where to reach Dr. Leune. And if there's anything we can do for you, we absolutely would love to. Have a great night.